Hey there viewers, and welcome back to another video. Today we will be presenting Warren Buffett's 12 rules of investing. But before we dive in, don't forget to like and subscribe to our channel and turn on notifications to stay up to date for our coming informative videos. Now, with that out of the way, let's dive in. He is considered the best investor of all time, called the Oracle of Omaha. He has held the position of the richest man in the world on several occasions. He made his first investment in the stock market when he was only 12 years old with his own savings. At the age of 20 years old, he met who would be his investment mentor, Benjamin Graham, better known as the father of fundamental analysis. At the end of this video, you will learn valuable business lessons that have taken him more than 80 years of experience. Rule number 1 is to focus on long-term value. Buffett is known for his patient approach to investing, and he looks for companies with a strong track record of profitability and growth. He believes that the best investment opportunities are those that can deliver sustainable growth and value over the long term, rather than short-term gains. Rule number 2 is to buy low and sell high. This means that you should look for companies that are undervalued by the market, and that have the potential to grow in value over time. When you buy a stock that is undervalued, you are essentially buying a company at a discount, and you stand to benefit when the market recognizes its true value. Rule number 3 is to do not invest in businesses you don't understand. Before entering a business or investment, you must understand how it works. In the same way that you wouldn't enter a baseball game without knowing the rules, you must first inform yourself as much as possible about that investment and understand it to enter the stock market with confidence. Rule number 4 is buy in panic, sell in euphoria. This means that when there is fear and investors are selling in panic, such as during a crisis season, it is the best opportunity to invest because the market is cheaper. Another way Buffett says it is, be greedy when others are fearful, and be fearful when others are greedy. Rule number 5 is to invest in companies that can be managed by idiots. Buffett suggests that even if a company's executives make bad decisions, the company in which you invest your money must be so good that even when managed by idiotic executives, it continues to generate good profits. Rule number 6 is to invest, don't speculate. Be an investor, not a speculator. An investor is formed with solid investment knowledge, time, and experience. Don't turn the stock market into a casino. Don't speculate or guess. Form yourself as an investor through solid knowledge. Study, understand the market first, learn, and then invest. Rule number 7 is do not diversify your investments too much. Those who really know how to invest identify a few stocks and put their money in those stocks. Another way to say it is to put your eggs in a few baskets and carefully watch around these baskets by closely following the quarterly reports of the companies to know how their investments are going. It means being careful around the basket where you put your eggs. It's not about investing the money and forgetting about the stocks. It's about staying on top of the financial statements the company is continually reporting. Rule number 8 is to allow Mr. Market to be your friend, is a valuable lesson taught to Warren Buffett by Benjamin Graham, the father of fundamental analysis, of whom Buffett was a loyal disciple. He learned the valuable lesson that you should be friends with the trend and not go against the market. As Graham refers to the stock market, it is there to help you, not to be understood, because the market is sometimes irrational. Therefore, let the market be your friend, and do not invest against the trend. Rule number 9 is to be the owner of a company at an early age. Buffett understood that you should not only invest in other companies, but you should also take a company public. Investing from within a company, that is, being the owner of a company and taking it public on the stock market, will give you the best returns, unlike investing from the outside by buying shares, which is what most investors do. Rule number 10, do not involve emotions in your investment decisions, and do not fall in love with companies just because you like the products they produce or because they were worked on by your grandfather. If these companies do not have fundamental data that demonstrates that they are good companies, you simply should not invest in them. Also, if you enter the stock market and see your stocks drop, do not panic and sell them. If you know it's a good company, you should be willing to watch your stocks fall up to 50% investments. If you sell, you will only be the debtor of that loss and miss the opportunity to see them rise again later. In other words, control your emotions. A man who does not control his emotions is a man who does not control his investments. He stresses the importance of diversification in managing risk in investments. He advises investors to spread their investments across different asset classes and industries to mitigate the impact of a potential downturn in any one sector. Rule number 11: always be willing to break your own rules whenever the market allows it. You should break some of the rules mentioned above. That is, if the opportunity to make money is so good but contradicts one of the rules, you should break them to be entitled to a good gain. Buffett has broken several of his rules by diversifying too much on some occasions and also by making mistakes in investing too much money in one of his companies, Berkshire, which was initially a textile company with no future that ultimately only kept the name of the company as it was a bad business. Rule number 12: what you earned investing is to give it away. Buffett has a different mindset from most entrepreneurs and billionaires in history. He has developed a spiritual sense, which has led him to make the decision that if life gives you the opportunity to make as much money, that money does not belong to you at the end, you must return it. He has stated for many years that on the day of his death, his children will not inherit a single dollar. He has said this publicly on many occasions. Instead, all his fortune will go to an investment fund, and its profits will be donated. Stay informed and keep yourself updated with information and continuously learn about investments and the broader economic environment. If you want to learn more about this topic, just visit the link in the description down below. If you liked this video, please give us a thumbs up. Don't forget to subscribe to our channel and hit the little bell to continue making informative videos just like this one. Thanks for watching.